This is an analysis from Alpha Business Media. Welcome back. So today, we are going to unpack a pretty fundamental, I'd even call it a seismic shift that's been happening in Nepal's commerce landscape. For a while, the big story was all about this appeal of fast, easy money, the sort of gold rush of what they call general store dropshipping.
Oh, it was an absolutely intoxicating model, and it lured in, countless young entrepreneurs. That whole era, roughly 2018 to maybe 2021, it was all built on a very simple premise. Low inventory risk, super low friction. You'd find some quirky gadget on a marketplace like AliExpress, mark it up 300%, maybe more, and just focus on digital marketing.
The zero inventory dream.
It was, in theory, the zero inventory dream, yes.
But the reality, and this is based on all of the sources we've looked at, is that this low-friction path, it's just crashed. That whole era is definitively over. It just hit a wall of regulatory reality, and I think just as importantly, market exhaustion. So our mission today is pretty clear. We need to do a precise autopsy on that collapse, figure out exactly why the old model died, and then we'll dissect the only real path forward now for serious business builders, which is this strategic pivot away from simple arbitrage to building a genuine private label asset.
And this is so much more than just a change in tactics. What we're really witnessing is a complete re-engineering of the e-commerce DNA in Nepal. The barrier to entry, it hasn't gone away. It's just, it's mutated. It's migrated from a technical hurdle, setting up a simple web page, to needing real capital and some serious operational sophistication.
Okay, so let's start that autopsy. What were the big forces, the two powerful, interconnected forces that basically acted as the executioners for that easy dropshipping model? Because at its core, that old structure really relied on a permissive environment that was never going to last, was it?
That's the core vulnerability, exactly. So force number one was the structural and financial crackdown. This was mainly initiated by the government. And the main executioner, it wasn't just higher taxes, it was the Department of Customs completely changing its approach. They moved away from what was, for a long time, an informal customs lottery.
Right, where little e-commerce parcels might just slip through if you got lucky.
Precisely. They moved from that to this stringent, non-negotiable enforcement of something called the Valuation Reference Index, or the Sundar Basucci.
And this one bureaucratic shift, it just shredded the unit economics, like overnight. How exactly did the Sundar Basucci kill profitability so effectively?
Well, the index was always designed for massive bulk commercial imports. It was never intended for these low-value individual parcels that are the bread and butter of dropshipping. So you might source a basic smartwatch for, say, $8 from the factory. The customs agent, they look at the index, and they might just arbitrarily assign a reference value of $30.
And that is the absolute killer. Because you're not just paying the standard duties, 15 to 30% and the 13% VAT. You're paying all of that, calculated on that wildly inflated $30 value, not your actual $8 cost.
Exactly. The second you calculate all those costs onto that artificial price floor, your final landed cost for that little watch, it often just skyrockets past what any rational Nepali consumer would ever pay for it. The profit margin, just poof, it vaporized. This wasn't just a higher expense. It really functioned as an impassable non-tariff barrier. It made the entire business model mathematically impossible.
So while customs is slamming the door on imports, you had the Nepal Rashtra Bank, the NRB, tightening the financial side of things. They were effectively closing the payment door.
Absolutely. The NRB restrictions, and these were mostly motivated by worries over foreign exchange reserves, they really constrained international payments. And while the dollar card was, a step forward for consumers, its annual spending cap, usually around $500, that is a massive bottleneck for any kind of commerce.
Just to put that in perspective for you listening.
Yeah.
That $500 cap, it's like trying to fuel a commercial jet with a garden hose. You just cannot scale a business that way.
You can't. A serious entrepreneur, someone running a scaling commercial venture, they cannot pay their international suppliers with a payment allowance that was designed for, personal Netflix subscriptions. It just guarantees you stagnate.
Okay, so that covers the structural breakdown. But then there's the second force, which is maybe the harder one to fix. This is the self-inflicted wound, the huge trust deficit the market is now dealing with.
And this is the gravest legacy of that whole gold rush era. Because the barrier to entry was so low, the market was just flooded with thousands of these transient sellers. They were optimized for one thing: short-term profit. They sold products that looked amazing in a sponsored video on social media, but were, in reality, just abysmal.
Yeah, we're talking about that classic frustration, right? You order what looks like premium headphones, and you get something that feels like cheap plastic from a vending machine.
Mm-hmm.
And the service was awful.
Awful. And on top of that, you've got the standard 45-day shipping times because it's coming
Huh.
straight from Shenzhen via e-packet, and then absolutely zero customer service after they have your money. So the consequence,
Yeah.
Nepali consumers became, I'd say, functionally hyper-skeptical. They basically learned to equate online shopping from some unknown brand with a very high chance of being cheated.
And that erosion of trust is incredibly expensive for the new players. Any legitimate new company today, they don't just have to sell a product. They have to do the much more difficult, much more expensive job of manufacturing credibility from scratch.
It forces them to spend a lot of money just signaling that they're reliable long before they can even talk about the features of what they're selling.
So if that's the death of the old model, the new one has to solve both of those problems, the structural and the trust problems, at the same time. So let's get to the solution.
This pivot to private label. And it feels like a fundamental philosophical shift, right? Moving from just exploiting temporary gaps, arbitrage, to building a real, durable brand asset with equity.
It is the mandatory evolution. You have to go from being a random reseller to an intentional brand owner. And that whole process, it starts by changing your sourcing platform entirely. You stop using AliExpress, which is mostly business to consumer, B2C, and you move over to Alibaba, which is a business to business, a B2B platform.
Okay, and what does that one shift immediately let an entrepreneur do on the logistics side? Consolidation and formalization. It's a game changer. So instead of 100 random, low-value parcels causing chaos at customs, the entrepreneur negotiates a single bulk order, a minimum order quantity, an MOQ of maybe 100 to 500 units, and they organize one single formal commercial shipment.
Okay, I get the logistics benefit, but let me just play devil's advocate here for a second. Doesn't negotiating MOQs and bulk imports, doesn't that require a lot more upfront cash than your average dropshipper has? Isn't the barrier to entry now just too high for a young entrepreneur?
It requires more capital, yes, but the risk profile is actually lower and, crucially, more predictable than the old way. See, when you place a formal commercial shipment, you have a legitimate commercial invoice. This lets you negotiate duties and pay them as a predictable business expense, not some random margin-killing customs lottery. That one act of ordering in bulk, it turns the customs barrier from a fatal problem into just another manageable business cost. And your shipping cost per unit, even by air, is a fraction of those old e-packet costs.
So you're trading a higher capital need for way more financial predictability. That makes a lot of sense. But the real strategic win here is how this new model just aggressively attacks that trust deficit we were talking about. How does holding your own inventory actually manufacture credibility?
It speaks volumes about your commitment. The immediate returns are speed and accountability. If you hold inventory locally, even in a small warehouse or a spare room, you can guarantee 1 to 3 day delivery within the Kathmandu Valley. That is such a powerful signal of reliability compared to the 45-day wait that, defined and killed the old model.
It completely changes the customer's expectation. You're moving from, I hope this shows up someday, to I can actually rely on this brand.
Exactly. And beyond just speed, the brand gets total quality control. You can physically inspect the product yourself before it goes out. You can make sure the packaging is high quality, it's branded. That reinforces accountability. When you put your own Nepali brand name on that box, you're signaling, I stand behind this. And that's what lets you offer a credible return policy, a real warranty.
So in effect, by taking on the inventory risk, the capital risk, you are literally insourcing trust.
And that is the very definition of creating a durable economic moat. This new model is hard to copy quickly. It takes investment, it takes know-how in international logistics, and a real commitment to customer service. All things that protect a serious business from the fly-by-night opportunist.
This is where it gets really interesting for me because you have these entrepreneurs who are innovating, but their potential is being capped by the infrastructure around them. To really see the scale of what's possible, we have to look south. India's booming direct-to-consumer or DTC market, brands like Boat or Mama Earth. That gives us a critical blueprint for what Nepal's trajectory could be, but it also shows some huge missing pieces.
The Indian D2C explosion was really catalyzed by 3 robust infrastructural factors that Nepal just doesn't have yet in a cohesive national form. And these are the ecosystem constraints that are acting as a real drag on growth.
Let's start with digital payments. India had the revolutionary UPI system. What's the functional difference? What does that do that our fragmented wallets and cash on delivery or UO can't?
Well, UPI created this free, instant, and universally interoperable payment system that just dramatically cut India's reliance on cash on delivery. In Nepal, even though we have some strong digital wallets, the ecosystem is so fragmented that COD is still king for e-commerce.
And the problem with COD, especially when you try to scale, is that it's just a huge drag on your efficiency, isn't it?
It introduces massive risk and volatility into the business. Every single pseudo order carries what they call the Janchot factor, the chance the customer returns it or just isn't home. So businesses have to build these huge buffers into their cash flow to handle failed deliveries. That constant uncertainty about getting paid, it really constrains a brand's ability to reinvest and grow.
Okay, factor two, logistics maturity. India has national third-party logistics networks, 3PLs like delivery, that are specialized for e-commerce.
And this is a professional service that Nepali entrepreneurs often have to do entirely by themselves. Our domestic couriers are developing, but they haven't reached that scale, that level of technological integration of a mature 3PL network.
And that distinction is so important. A 3PL doesn't just deliver the package. What else does it solve for you?
It solves the hardest part of e-commerce, reverse logistics. When a customer wants to return something, a professional 3PL handles the pickup, the tracking, the verification, and getting it back to your warehouse safely. If you're trying to insource trust by offering good warranties, being able to manage professional reverse logistics is non-negotiable. For so many private labelers here, fulfillment is this exhausting in-house operational burden. It just diverts time and money from what they should be doing, product innovation and marketing.
And the final piece is just clarity in the law.
Yeah, India formalized the whole sector with things like the Consumer Protection e-commerce rules of 2020 and the GST. That clarity built a ton of confidence. It told consumers, banks, investors that e-commerce was a legitimate sector with rules. Nepal, on the other hand, is still in this regulatory gray area. It's a patchwork of old laws that were never designed for online sales. And that ambiguity, it chills legitimate investment. It makes it really hard for a good private label business to stand out from the fraudsters.
So the takeaway is pretty clear. There's a ton of entrepreneurial grit. But that broad-scale growth is going to be structurally held back until those parallel infrastructures, payments, logistics, and law are built to actually support a real D2C economy.
The hard truth that everyone has to internalize is this: that dream of friction-free, risk-free online business based on arbitrage. It's dead. The future belongs entirely to the dedicated, capitalized, and sophisticated business builder.
So looking ahead maybe to 2026, our sources sketch out three main strategic scenarios for the winners in this next era. Let's start with scenario one, the rise of the hybrid private labeler.
This is the really smart play, the one that balances capital risk. Their core business, their main revenue, it will come from their bulk imported, warehoused private label stuff. That's what builds the brand and guarantees the quality and speed. But they will strategically use single unit dropshipping not as a business model, but as a lean, low-cost market research tool.
So they test out new product ideas using AliExpress, spending almost nothing, and if a product gets real traction and good feedback, then it sort of graduates into their core portfolio to be imported in bulk.
Exactly. It minimizes your inventory risk, but maximizes your agility to spot the next trend. Okay, scenario two is the niche dominator. As the market matures and gets more competitive, the real winners will stop trying to be these broad, general stores.
They'll focus on just dominating a very specific defensible niche. So we're talking about, what, specialized equipment for artisanal coffee brewing maybe, or high-performance gear, specifically for trail runners who demand quality.
Yes, those consumer groups, they prioritize specialized knowledge and verified quality way more than just a rock-bottom price. And that lets the private labeler build a really strong moat based on their expertise and command premium pricing. It insulates them from the generic price wars.
And finally, scenario three, the infrastructure play.
Right. So recognizing all this friction we talked about in logistics and tech, there's a huge opportunity for a B2B player to build this Shopify for Nepal. This would be the integrated platform that solves all those operational headaches for the private labeler. It would offer integrated local payment gateways, negotiate bulk courier rates for them, and crucially, provide outsourced fulfillment as a service. This kind of infrastructure play would catalyze the growth of the whole ecosystem.
The shift is just profound, really. The barrier to entry has completely moved from a simple technical hurdle to a sophisticated strategic and operational one. Success is now all about patient brand building and customer experience, not just finding the next clever widget.
The key insight is simple, really. The market is no longer rewarding people who exploit temporary gaps. It's rewarding those who commit to creating durable brand equity and building real assets.
And that leaves us with a final provocative thought for you to consider. Given this absolute need for ecosystem support, which one element robust digital payment interoperability that finally kills our reliance on SIA, a mature 3PL network that can handle professional reverse logistics, or a comprehensive dedicated e-commerce act, which of those is the single most necessary piece of infrastructure that Nepal has to build first to truly unleash its private label D2C boom?
The entrepreneurs are already doing their part. They're pivoting. The next stage of growth is just waiting for the infrastructure to catch up.
Thank you for joining us on this deep dive into the future of e-commerce strategy. We hope this analysis helps inform your decisions moving forward.